We looked across the piece of banking. We did a report called Banking Disrupted, then we did a report called Payments Disrupted, and we started a report on lending with a provisional working title, Lending Disrupted, because we thought from everything that we had looked at about peer-to-peer and marketplace lending, we thought that this would be a model that would quote-unquote disrupt banking. And those of you who know your strategy will know that the word disruption has got a very specific meaning. And what it means is when there's a change, when there's a new player who does something that is very difficult for the incumbents to respond to. So that's what we expected to find when we modeled marketplace lending. But actually, when we did model the economics of marketplace lending, we did indeed find that marketplace lending had a lot of advantages over traditional banks. Specifically, if we look at the user experience that Tom mentioned, we found that users favored the speed and convenience and ease of use that you find in marketplace lending. And to our surprise, in fact, we found that it trumped rates for retail borrowers. We thought that it would be all about the rate. It wasn't. In fact, the top three things that people were looking for were all about ease of use, customer experience. But then we also looked at OpEx. So in terms of operational expense, again, this was something that people who'd analyzed marketplace lending had really emphasized. They said, here you have the banks, they're lumbered with these huge branch networks, which you don't need anymore. They're lumbered with legacy IT. So these nimble new tech companies actually can come in and sweep away the need for all of those things and therefore end up with a much lower marginal cost. And yes, indeed, we found that the operating expenses, specifically the marginal cost of a loan made by an MPL, was indeed a lot lower. However, what we also found is that if you look at funding costs, and I heard that mentioned in the earlier panel, banks have an advantage on funding costs. And of course, the other thing is that fintechs and marketplace lenders, to be successful, they have to be platforms. It's a term we've heard a lot this morning. It's a term that we hear a lot in Silicon Valley. These are network businesses. Therefore, to be successful, they need scale. The marginal cost may be low, but the total cost either of building the platform or indeed of marketing yourself, of acquiring customers is very much non-trivial. So when we looked at that in the round, we found that, frankly, MPLs and banks at the moment in the UK are roughly comparable. I stress that this is a UK piece of research. However, of course, we're in a highly unusual interest rate environment, an interest rate environment that we hadn't seen in the 300-year history of the Bank of England. Of course, a lot of young people in the room, they may not remember really a world of kind of higher interest rates. But of course, if you look at the broad sweep of history, this is a very unusual experience. So we expect that when rates normalize, that funding cost advantage that banks enjoy will become more important. Now, we are not saying to banks, relax, rest, everything is fine. We're saying that there is a lot that you can learn from MPLs, specifically on the user experience, specifically on that kind of streamlined operations. And what we expect will be the model is that actually we will see partnerships, there are varying types of partnerships between banks and fintechs, and we will end up in a world where you have a superior customer experience, and so the consumer will benefit.